Hi everyone. Today we're going to talk about something that landed in the budget this year, the 2025 budget, which is the investment boost. So it kicked off in May 2025 and it's all about encouraging New Zealand businesses to invest in new assets, whether that be machinery, tools, software, or something else. The idea is that you get a bigger tax deduction up front, so your cash flow improves when you're spending money to grow your business. But what's really important is it's not a cash grant or bonus from IRD, it's a timing benefit. So, meaning you're going to get the same total amount of deductions over an asset's life, you're just going to get more of them sooner. So, what is it? So, it's a 20% upfront tax deduction on the cost of new or new to New Zealand assets. It's on top of your normal depreciation, and there's no cap on how much value qualifies and no limit on the amount of assets. It's also optional. Again, it is about timing, so you're not claiming more deductions than you would usually get. You're getting the same deductions overall, you're just getting sooner rather than later, so that can really help with your cash flow when you've shelled out for a big purchase. What qualifies? So what qualifies as new or new to New Zealand depreciable assets? So that's things like machinery, vehicles, tools, tech, fit outs. What doesn't qualify is land because it's not depreciable, residential property, or assets already in New Zealand that are used. So let's run through a little example. So let's say you buy a new machine for 100k, and for argument's sake you buy it right at the start of the tax year, and this is after this May when this new investment boost scheme came in. So ordinarily without the boost you'd get to claim 10% depreciation when we come to do your financial statements, and in your year one claim you'd get 10% of that purchase price, so $10,000 as a claim, and in future years you've got $90,000 left to claim. With the boost, you're going to get 20% upfront of the purchase price, so that's $20,000, plus you're going to get 10% on the rest of the cost price, so that remaining $80,000 of cost price, you're going to get 10% depreciation on that too, meaning your claim is $28,000 with the boost. So you're getting more now, less later, but you're going to get the same deductions over time. So with that investment boost, we got to claim an extra $18,000 up front. So that's a 28,000 deduction in year one that's going to come off your taxable profit. And so an $18,000 extra benefit, and the tax benefit of that is $5,040 if you're a company. So that's adding to your cash flow another $5,040. What if you sell the asset later? So if you sell the asset down the track, you might have to pay back part of that deduction that you got, which is called depreciation recovery. So it's just something to be aware of. It's not anything different than would normally occur when you sell an asset. It's just because you're getting extra deductions up front, it might mean that you're depreciating that asset quicker than normal. And so when you sell it, the tax book value might be less than it normally would be at that time, creating depreciation recovery income. So yeah, it's nothing sneaky, it's just the normal tax balancing rule. You claim to the cost early, so if you recoup it later, IRD adjusts things back. So something to keep in mind. So why the investment boost still helps your business is it's better for short-term cash flow because you're getting more claims upfront, reducing your tax to pay, which is directly increasing the cash flow in your business. It encourages new investment, and it's optional, so you only have to use it when it makes sense to do so, or although in most cases it would make sense to get this extra claim. So even though it's not extra money, it's bringing those deductions forward, which can still really help your cash flow. So yeah, that's a quick refresher and informational video on the investment boost. But as always, talk to your accountant about it to see how it can really impact your business.